Imagine a massive tidal wave, but not water, it's debt. A very real threat, poised to swamp 75 of the world's poorest nations next year in 2025.
Yeah, and a record-breaking $22 billion is due just to China alone.
Exactly. But as we'll unpack today, that's really just one piece of this huge global puzzle. Welcome to the deep dive. Today, we're plunging right into the escalating global debt crisis.
We'll be untangling this complex blend of fiscal, monetary, and geopolitical factors.
Right, things that have converged to create what many are calling a polycrisis.
That's the idea, a cluster of global crises, all linked, each making the others worse. The whole is sort of greater than the sum of its parts.
And it's having profound impacts on human lives and global development goals. It's happening right now.
And our mission today is really to cut through the noise. We want to deliver the essential insights from a lot of different sources.
We've got detailed reports from leading think tanks, development organizations, even some fascinating historical analyses.
The aim is to give you a shortcut, really, to being truly well-informed on this critical issue.
Exactly. We'll explore who owes what, why the situation has become, frankly, so dire, and what transformative changes are being proposed to, hopefully avert an even deeper catastrophe. So let's dig in.
Okay, so the sheer scale of this global debt, it's truly staggering.
So just how big are we talking?
By 2023, it hit an unprecedented $307 trillion global debt.
$307 trillion, that's almost hard to comprehend.
It is. And just to give you some context, the public sector, so governments, accounted for over $97 trillion of that.
Wow. And that's up significantly from before the pandemic.
It's 25% higher than pre-pandemic levels. A huge jump.
And you hear a lot about developing economies being particularly affected. What's the trend there?
They've really been, let's say, hooked on debt over the last 15 years. Our sources show they've increased their debt load by an average of 6 percentage points of GDP every year.
6 points of GDP annually? What does that actually mean for their budgets day to day?
It means an enormous drain. For countries borrowing from the World Bank, debt service, just paying the interest and principal, took up an average of 43% of their budget revenue in 2024.
Almost half.
Almost half. And for low-income countries, it jumps to 53%. For lower middle-income countries, it's 51%.
Over half their income just gone, paying off loans before they can even think about investing in their own future.
Precisely. It's a huge constraint.
Now, a major player often mentioned in this is the China factor. What's the significance there, especially looking ahead to 2025?
Yeah, that's crucial. In 2025, those 75 poorest countries we mentioned, they face a record $22 billion in debt repayments, specifically to China.
And where did these loans mostly come from?
Primarily from loans under Beijing's Belt and Road Initiative, the BRI. That huge state-backed infrastructure program launched back in 2013.
Right. The BRI certainly made China the largest global supplier of these bilateral loans for a while. I think it peaked around $50 billion in 2016.
That's right, more than all Western creditors combined at that point.
But I understand that flow is changing. New Chinese lending is reportedly drying up.
It seems to be, yes. It implies a pretty significant shift. One report we looked at actually states that for the rest of this decade, China will likely be more debt collector than banker to the developing world.
More debt collector than banker, that definitely changes the dynamic.
Absolutely. For many nations that relied on that capital.
And this brings up a really important point about the broader landscape of creditors. It's not just China, is it?
No, not at all. It's critical to understand that many developing nations are also significantly indebted to private Western lenders, bondholders, commercial banks.
And this isn't just a small slice of the pie anymore.
Far from it.
Right.
Private creditors now hold over 56% of the debt for low and middle income countries, LMICs.
Over half. And what's different about that private debt?
Well, here's the kicker.
Yeah.
These loans often come with higher interest rates and shorter repayment periods compared to the official loans from governments or multilateral institutions like the World Bank or IMF.
So more expensive and needs paying back faster.
Exactly. For instance, back in 2022, African governments actually owed 3 times more to these private financial groups than they did to China.
3 times more.
And those private lenders often charged double the interest rate.
Double. Wow. And is this burden concentrated somewhere, or is it widespread?
It's pretty widespread, but some regions feel it more acutely. Sub-Saharan Africa, for example, is spending, on average, 55% of its revenue just on debt service.
55%. That's unsustainable.
It certainly looks that way. Asia isn't far behind at 42%, and Latin America is at 35%. It really is a global challenge.
So, okay, why is this debt surging now? It sounds like, well, like a perfect storm of factors. What created this situation?
You're right, it's not just one thing. If we look back, a big part of it is the legacy of those super low interest rates after the 2008 global financial crisis.
Right, rates in the US and Europe were near zero for years.
Exactly. And that pushed investors hungry for returns to look towards developing economies and emerging markets where they could get a better yield.
And many of these developing countries, the LMICs, saw that as an opportunity, right, to get funding for infrastructure, for development.
Precisely. They were eager for capital. Many issued international bonds for the very first time during this period.
But that came with risks.
Huge risks, in hindsight. It significantly increased their exposure to exchange rate fluctuations because these bonds are often in dollars, and also to refinancing risks down the line. Basically what happens when the loan needs to be rolled over.
Okay, so that set the stage. Then came these compounding global shocks. What were the big ones?
Well, first, obviously, the COVID-19 pandemic. LMICs had to borrow more, often urgently, to provide financial support to households, to businesses, just to cope.
And how did creditors react then?
Private creditors became quite risk-averse, understandably, but multilateral development banks, like the World Bank, they really stepped up and significantly increased their emergency financing.
Okay, then after the pandemic dust settles, or even during it, we get geopolitical conflicts, the war in Ukraine being a major one.
Yes, and other flashpoints, too. These disrupted trade, supply chains, and really pushed global inflation up to its highest level since 2008 again.
And how did the big central banks respond to that inflation spike?
With very aggressive monetary tightening. Central banks, especially the U.S. Federal Reserve, started hiking interest rates incredibly fast.
Yeah, from near zero to over 5% in just 2 years, that's a massive shift.
A dramatic shift, and it sent shockwaves globally.
So what was the immediate ripple effect on these developing economies already struggling with debt?
It was profound, really. Higher interest rates in the U.S. just sucked capital away from developing countries. Money flowed back to safer U.S. assets.
Which made it more expensive for them to borrow.
Much more expensive. It raised their borrowing costs and also caused their currencies to depreciate against the dollar.
Which makes paying back those dollar-denominated loans even harder.
Exactly. Suddenly, the same loan costs much more in their local currency. The UN highlights this disparity developing country. Borrowing costs are, on average, 2 to 4 times higher than in the U.S.
2 to 4 times, and even more compared to Germany.
6 to 12 times higher than in Germany. It's a huge disadvantage. Countries like Turkey and Argentina have been and remain particularly vulnerable to these shifts.
Okay, let's talk about the impacts, the real-world consequences. We hear this term doom loop for development. What does that actually mean on the ground?
It means they're trapped, essentially. To make these huge debt service payments, governments are forced to cut spending on critical public services.
Like what?
Like education, healthcare, essential infrastructure, the very things they need to invest in for future economic growth and well-being.
So the debt itself prevents the development needed to eventually pay off the debt and escape the cycle.
That's the loop. And the numbers illustrating this are pretty stark.
Give us an example.
In 2023, LMIC's debt servicing costs hit a record $1.4 trillion. That ate up 3.7% of their combined gross national income.
$1.4 trillion, just servicing debt.
And put it this way, spending on debt service is now 2.5 times more than spending on education, 4 times more than on health, and get this, 11 times more than on social protection programs.
11 times more on paying old loans than on, say, safety nets for the poorest people. That really paints a picture of the human cost.
It absolutely does. It highlights the brutal trade-offs governments are facing.
And just for context, this isn't only a developing world issue, right? Even developed economies feel the weight of debt service.
That's a fair point. Italy's debt servicing costs, for instance, are projected to hit 4.5% of its GDP by 2025. That's roughly equivalent to its entire education budget.
Its entire education budget.
And Japan's situation is even more extreme. Their debt servicing costs are expected to be 5 times larger than their education budget. It shows the massive fiscal pressure debt creates, well, everywhere. But the impact is just catastrophic in poorer nations.
This high debt burden must have severe consequences for human rights and social equity, too.
Absolutely. When governments have to cut spending so drastically, their ability to guarantee basic human rights access to food, clean water, healthcare is undermined.
And are there specific groups disproportionately affected?
Yes, the impact is often particularly acute for women and girls. We see increased unpaid care burdens as public services shrink, limited access to health facilities, reduced school attendance, all of which further entrenches gender inequality.
And then there's the climate angle. This seems to add another really vicious layer to this doom loop.
It really does. LMICs are often on the front lines of climate change, facing more frequent and severe environmental shocks, storms, droughts, floods.
Which forces them to borrow more.
Exactly. They need funds for disaster response, for recovery, for rebuilding. So climate shocks push them deeper into debt.
It's a cycle.
It is. Over 40% of small island developing states, SIDs, think of nations in the Caribbean or Pacific, are at high risk of debt distress. At the same time, they face an existential threat from rising sea levels and climate change.
Yet they're spending more on debt.
Far more. In 2023, LMICs spent, on average, 12 times more on servicing their debt than they did on climate adaptation measures.
12 times more on paying lenders than on protecting themselves from climate disaster. That's...
And this toxic mix of unsustainable debt and climate shocks. It's also been correlated with state fragility. It can lead to further political instability, economic collapse. It's a real security risk, too.
It sounds like a domino effect. And what about the more immediate, short-term economic pain?
Well, a debt crisis typically causes unemployment to rise. Governments cut spending, businesses lose confidence and stop investing, consumers spend less.
Do we have examples?
Sure. During the 2008 crisis aftermath, unemployment in Eurozone countries like Greece jumped significantly, from around 8% to nearly 13%.
And what happens in the financial markets?
Volatility shoots up. Investors get scared, they start selling off assets from the affected country, leading to big price swings and making it even more expensive for that country to borrow later on. The risk premium goes up.
That can trigger capital flight, right? Money leaving the country.
Yes, exactly. And often, the country's currency depreciates sharply.
Which makes imports more expensive.
Adds to inflation.
And makes that foreign debt even harder to repay.
It's a cascade of negative economic effects hitting people hard.
Okay, so we've painted this picture of the current crisis, its causes, its devastating effects. It's easy to think this is entirely new, but, history often rhymes, doesn't it?
It certainly does. And there are fascinating lessons if we look back, especially concerning sovereign debt crises.
Where should we look?
Well, there's a really remarkable parallel back in the 1820s. The 1825-1826 collapse of Latin American and Southern European sovereign debt, primarily traded on the London market.
The 1820s. How is that relevant today?
Well, back then, early forms of securitization led to this surge of new government bonds hitting the market. Some were legitimate, some were, frankly, junk bonds. There's a famous example of bonds issued for the entirely fictional Kingdom of Poyais.
An imaginary kingdom.
Yeah,
Seriously.
absolutely. And crucially, there were no credit rating agencies like we have today to help investors tell the difference.
Okay, so a speculative bubble based on, well, sometimes nothing. What triggered the collapse?
The collapse itself happened in autumn 1825. And part of the blame was placed on the Bank of England raising interest rates.
Sounds familiar.
Doesn't it? But here's where it gets really interesting for today's context. Amidst all that chaos, deals sponsored by the Rothschild banking house performed noticeably better.
Why was that?
Well, the Rothschilds had immense confidence in the deals they structured, so much so they actually took the entire bond issue for the Kingdom of Naples onto their own books.
They bought their own product, essentially.
Effectively, yes. It amounted to something like 15% of the entire assets of their Paris house. A huge commitment.
That's putting your money where your mouth is.
Absolutely. And they went further. They offered to buy future interest payments, the coupons, providing what was essentially outright insurance against default. They even used diplomatic channels to try and help Naples manage its finances better.
So they weren't just arranging the deal and walking away. They were deeply involved after the bonds were issued.
Exactly. That's the key enduring lesson. The sources suggest the Rothschilds weathered that storm partly because they were, quote, sitting on a mountain of capital, apparently 10 times their nearest rival, but also because they provided these significant post-issue services.
Active engagement, risk mitigation, support.
Yes. And the historical analysis suggests this is a crucial lesson for today's global investment banks. Maybe in a more laissez-faire world, you can't just rely on central banks to bail everyone out. Robust capital and genuine commitment to the borrower's success are key.
Which feels quite different from how things often work now.
It does. Despite these historical echoes, the current international financial system still lacks really effective, agreed-upon institutions for sovereign debt workouts.
No single process.
No. There's no single comprehensive bankruptcy court for countries, if you like. Addressing debt Often involves this myriad of parallel processes, which can be messy and inefficient.
And the private creditor problem we talked about earlier seems particularly tricky in this modern system.
It really is. They often charge those very high interest rates we mentioned, over 9% in Angola, over 10% in Ghana for foreign currency loans.
And transparency is an issue.
A big one. It's often hard to even know who holds the bonds, which obviously hinders restructuring efforts and can, some argue, facilitate things like tax dodging.
And there's this free rider problem.
Yes, that's a classic challenge in debt restructuring. Individual private creditors often have an incentive to hold out, to refuse to participate in a debt relief deal, hoping everyone else will take a haircut while they get paid in full.
Which makes purely voluntary restructuring very difficult.
Extremely difficult. We saw this clearly with the G20's Debt Service Suspension Initiative, the DSSI, during the pandemic. Private creditors basically had no participation at all.
Right. And then the G20 tried again with the Common Framework for Debt Treatments. How is that working out?
Well, it was adopted in 2020, aiming to coordinate all creditors, including China and private ones. But it's been heavily criticized as being too slow and complex,
How slow?
taking nearly 2 years just to reach key resolution milestones in some cases. And so far, it's delivered very little actual debt relief. Plus, it still struggles to compel that private creditor participation. It really underscores the systemic challenges we still face.
So, given these immense challenges, the historical lessons, the failures of recent initiatives, what are the proposed paths forward? What solutions are on the table?
Well, a critical first step, widely agreed upon, is the need for urgent debt relief to create fiscal space, breathing room for these countries.
What's the target level?
The aim often cited is to reduce debt service burdens to a more sustainable level, perhaps around 10% of government revenue for low-income countries and 15% for middle-income countries, down from the 50% plus we see in some places.
Okay, how do we get there? I know Development Finance International, DFI, has some specific ideas.
Yes, they propose tailored solutions depending on the country's situation. They group them into roughly 3 categories.
What's the first?
First, for about 34 countries that are quite dependent on borrowing from international markets. For them, DFI suggests credit enhancement measures.
What does that mean? Like guarantees?
Exactly. Things like guarantees from multilateral development banks, the MDBs like the World Bank or other development finance institutions, DFIs. The idea is to use the MDB's high credit rating to genuinely lower the borrowing costs for these countries.
Okay, makes sense. What about the second group? Countries less tied to markets.
Right. For about 51 countries that are less market dependent, the proposals are more direct. For the absolute worst, affected those spending over half their revenue on debt service. For instance, they suggest outright debt service cancellation or reducing the total stock of debt.
Just wiping some of it off the books?
Yes. For others in this group, not quite at crisis point, they propose long-term rescheduling, pushing payments far into the future, maybe with a 10-year grace period where they pay nothing.
A debt holiday?
Exactly. Some proposals specifically mention a 10-year debt service holiday to allow these countries to invest properly in the Sustainable Development Goals, the SDGs.
And the third category, disaster-hit nations.
Yes, for over 25 countries identified as being recently hit by major disasters, climate-related, earthquakes, or even pandemics like COVID, DFI, suggests an automatic cancellation of all debt service payments for 3 years following the event.
Regardless of their income level.
Regardless of income level, because a major disaster can cripple any economy.
So, taken together, these kinds of measures, plus maybe some new financing, could they make a real difference?
The proponents argue yes. Collectively, measures like these could potentially provide that U.S. $500 billion in fiscal space that the UN Secretary General has called for in his SDG stimulus plan. It's a significant amount.
That's substantial. But beyond just immediate relief, there seems to be a strong call for reforming the whole global debt architecture itself. Where does that start?
It often starts with overhauling how we assess debt sustainability in the first place. The Debt Sustainability Analysis, or DSA, mainly done by the IMF and World Bank.
What's wrong with the current approach?
It's often seen as being too optimistic, maybe not fully capturing all the risks. New DSAs, reformers argue, need to explicitly integrate a climate lens.
How so?
To properly account for climate-related risks like those disasters we mentioned and how they impact a country's ability to actually repay its debts long-term.
And it's not just climate.
No, the push is also to include an assessment of a country's essential spending needs, what it requires to support the well-being, health, human rights, gender rights, education of its population. Basically, can the country afford the debt and provide for its people?
And accounting for global trade issues, too.
Yes, factoring in the potential impacts of global trade tensions on their export earnings and their foreign currency reserves, which are crucial for repaying foreign debt.
What about those creditworthiness biases, especially for vulnerable states? How can that be addressed?
One key proposal is implementing multidimensional vulnerability indicators, or MEIs. The UN has already adopted these for small island developing states.
How are MVIs different?
Instead of just looking at income or GDP, MBIs emphasize factors like climate and disaster vulnerability, exposure to external shocks, lack of economic diversification. They try to give a broader picture of vulnerability beyond just the immediate ability to repay a loan next year.
And maybe recognizing the potential returns, too.
That's another angle. Highlighting the often high median return, one study suggests 18% on investments in LMICs, especially in things like infrastructure and public goods. Recognizing that potential could help mobilize funds, changing the narrative from just risk to opportunity as well.
Fostering trust and transparency seems absolutely vital, too. What's being proposed there?
Well, there are calls for a UN debt convention. This would aim to establish globally agreed, binding principles for responsible borrowing and lending.
Setting some rules of the game.
Exactly. And creating transparency mechanisms so everyone knows who owes what to whom, plus potentially setting up impartial arbitration processes for when debt relief is needed.
And getting private creditors to play ball.
That's where legislation in major creditor countries comes in. We're seeing proposals like the UK's Debt Relief Bill or New York State's Sovereign Debt Stability Act. The idea is to legally require private creditors holding debt governed by UK or New York law, which covers a huge amount of global debt, to participate in internationally agreed restructuring deals.
Closing that free rider loophole through domestic law.
Precisely. And another key element is empowering the indebted countries themselves.
How?
Through things like borrower coalitions and buyers clubs. Examples include the SID's Debt Support Service, the African Leaders Debt Relief Initiative, and the V20 group of climate vulnerable nations' climate prosperity plans, giving them a stronger collective voice in negotiations.
Okay, and what about monetary policy tools? Can central banks play a role?
They can, strategically. Where appropriate for a country's situation, lowering interest rates can reduce domestic borrowing costs and stimulate economic activity.
Injecting liquidity?
Yes. Measures like quantitative easing, central banks buying assets to push money into the system, could support lending and potentially boost tax revenue eventually. And in some cases, central bank intervention in foreign exchange markets might be needed to stabilize volatile currencies.
And finally, the role of the big international institutions.
The IMF and World Bank definitely continue to play a vital role. They provide not just loans, but also crucial technical assistance and policy advice to help countries manage their debt better and work towards economic stability. Strengthening that international cooperation remains key.
So we've really peeled back the layers today on what is a truly complex global debt crisis. We've seen its alarming scale, that perfect storm of factors that fueled it, and crucially, its devastating human and developmental costs.
We've also looked at those interesting historical echoes and explored some of the urgent, quite ambitious proposals for creating a fairer, more effective global financial system.
It seems the path forward really demands more than just, temporary fixes or kicking the can down the road. It sounds like it calls for a fundamental redesign of how the world manages sovereign debt.
I think that's right. And with global growth potentially slowing and interest rates likely staying higher than they were for a long time, the time for just hope over experience, as one report put it, might be running out. Action is needed.
So the final provocative thought for you, our listener. What does all this mean for you? How might a reimagined global financial system, one that perhaps genuinely prioritizes human well-being and climate resilience alongside financial stability, impact the future that we all share? Something to think about.